Hello everyone, and once again welcome back to another video. So in today's video we will be taking a look at one of the trades that I've executed over the past couple of days, and the reason why I've decided to select this specific one, so the pair you're taking a look at is the USD, so the US dollar against the Japanese yen, is because this specific trade taught me a lesson or proved the fact that trading is about probabilities, is a game of probabilities, and you've got to make sure that you stick to your trading plan. But unfortunately, sometimes the odds will not be in your favor, and they will just play against you. So it's important not to start questioning your journey or your trading plan or your routine, should you have one. So first of all, make sure that you have a detailed and finalized version of when exactly you will be taking a trade, in what position, following what sort of pattern, that sort of stuff. And after that, once you sort of backtest it and make sure that it fits within your personality and your routine, make sure that whenever things don't go too well, such as taking a couple of losses in a row, you don't start changing it and then tweaking it here and there. Sort of stick to it and then make sure that you don't lose faith. That's one the message I'm trying to convey. So this pair specifically sort of proved to me or was showing very clear structure. So 1, 2, 3, 1, 2, 3 on the weekly time frame. So we see that this massive pennant or structure that is going to converge towards this area here was was quite interesting, because the fact that we'll now, well, sooner rather than later, we'll now see price either adopting this sort of behavior, or it will have to either perhaps do this. So the first scenario or the second scenario are equally as likely. The second scenario, so the latter one, is what I had forecasted, and that's what I was expecting by looking at the most recent price structure, which is this one here that you can see, which is what I've decided to focus my attention on in order to dissect and analyze within detail the relevant price action. So this downtrend, so this downsloping trend line, which is the same one that you saw in the weekly time frame, I drew this because of the fact that it was connecting the dots, it was connecting the lines, and we were approaching once again that region. So I was ready to place in a trade, a short position, because of the fact that price was approaching that through a pattern, so 1, 2, 3, and then let's take a look at what happened. So by taking a look at the 4 hour, now let's just focus on this most recent price action. Okay, so 1, 2. I was expecting a third touch here, roughly. So perhaps like that, to then be ready to place an order to the downside. That didn't happen. So what I've exercised is something that we refer to as pattern separation. Okay, so in terms of pattern separation, what is this concept and what does it tell us? So the concept of pattern separation is a way in which we try to explain that the market is not a perfect machine. It does not have a perfect nature. So whenever we focus our attention onto something that could look quite clear at first, such as in this case, an expanding channel type formation, then what do we know? Well, after the first and second touch, we will be expecting a third touch onto the same trend line to then place a selling position. Well, that's not guaranteed. In fact, it didn't end up happening. So we've got to be able to adjust our judgment and analysis to be able to capitalize on different types of scenarios, because otherwise, if we have a crystal clear image into our brain about what we want the market to do, then most of the times the market won't do what we think it should have done, and therefore we will always hold back, and we will always sort of be quite fearful and hesitant. So we've got to make sure that we know how to capitalize on all the different types of scenarios whenever the first one does not then materialize. So in this case, the concept of pattern separation allows us to then think about the fact that this structure did not hold true anymore. So this blue line represents the override, which is the second useful or truthful scenario after the first one, when the first one did not take place. In fact, we no longer have a first, second, third touch, but we have a double top, which ended up being a third top, and then eventually break up to the outside and form than the pattern separation. So another distinct and clear pattern, which is this one here. So by taking a look at the 1 hour, this is what I was looking at. Okay, so first, second touch, quite clear. I was expecting a third touch, which is why my stop was at there. So I was ready for that to happen anyway. But then I was taking a look at this type formation, which on the 15-minute chart is even clearer, which we could call the hover. So the hover is whereby price sort of like stays there, hovers for a little bit before then committing to a bigger movement. This is what I was expecting, and therefore I placed a sell stop. A sell stop is not a market order. So a market order is an order in which you enter at that specific price. So in this case, USD JPY is trading at 109.438439. So you tell your broker that you're happy to execute that position at that price. But a sell stop is quite different in the sense that you place a limit order to this place here, and then once price reaches that level, then your order is filled or gets filled. So that's what I did. Now, taking a look at the 1 hour, I was expecting, okay, so a 30 pip stop loss. I was expecting about 3.5, 3.4 risk to reward ratio, so I was happy with the setup. I was quite confident that the confluence factors such as the down sloping trend line and the fact that we were going to approach the this descending type formation with the fact that this structure here could have confirmed then a third touch, well in this case a fourth touch to the downside. I was quite keen on placing this trade because of the fact that the probabilities were there. So I ended up being entered in the market after this hover here. So I placed my order over there. And then after a while, sort of like the position stuck around for like a little while without committing to a major movement. So what I did here, and that's the first note, is I applied the 0.5% rule. So price is being quite corrective and moving slowly. So it hasn't reached plus 1% of profit. So I haven't moved the stop loss to break even. Therefore moved 50% of the risk off the table by positioning the stop loss to half the stop loss level. So quite a few things to explain here. So first of all, the 0.5 or the 0.5% rule says that whenever we are expecting a move to the downside, such as this one here, for example, after the hover, which in this case would be this, when price then does not commit to this huge leg of impulsive move, but sort of like stays around there and doesn't really know what to do, goes up and down, then in that case, because of the fact that you then are likely to form a bigger structure before then eventually committing to the downside, the thought process that you should be applying is the fact that, okay, you're in the position now. The position is not then committing to the bigger structure, so you're not banking huge profits just yet. You've got to make sure that your risk is contained wherever possible. But because of the fact that we didn't break impulsively like we have done after the position was closed, and I'll tell you why after this brief explanation, then I've just removed half of the risk off the table. So position my stop loss here at the 15 pip limit. So 150, so 15 pip limit. So I was happy that half the position or half of the risk was going to be taken away from the table. So after a while then I saw that price came back down here, and that was about a 1% roughly, yeah, exactly 1% profit. So according to the sort of trading plan that I am structuring and refining over the course of the weeks and months, I have decided that after the first percentage of positive profit, I will then move my stop loss to break even. So that whenever the structure then decides, or should it ever decide to pull back, I'm then not prepared, or then I'm not willing to lose the 1% in, well, 1% of profit plus 1% of loss. I'm not willing to give back to the market a total of 2% of movement. And so in doing so, I will then be locking a tiny bit of profit by moving the position onto break even. And so the trade is completely risk free. But then look at what happened. So it retraced all these wicks there got filled, and then the position sort of gathered momentum, and for a very, very tiny bit, I got taken out. And then look at what happened after. Quite ironically, then the position started to commit towards the downside. Well, arguably, I could have perhaps opened another position, so impulse, correction, impulse, which is what we're expecting here. So I could have opened a second position like this, which I will show you with the risk reward trading tool, such as that, just below, with a stop just after, just above the structure for another 3 to 4%. But then I thought, okay, well, we're still sort of like approaching my initial target, so the risk reward tool is not going to then result in a huge gain, so I've decided to stay out. But then what's the main lesson that I'm learning from this? The main lesson is that whenever the structure is clear and you forecast something, which in this case ended up then going towards the right direction, and I'm expecting sort of this price to then continue at least here, if not then towards the outer structure, so that would be even better. Whenever then the odds play against you, then you should just sort of relax, hold back, and then look for the next trade, because of the fact that the market is imperfect, is definitely not gonna do what you want it to do or what you tell it to do, because of the fact that there's so many other players, there's millions and millions of other players around the world that sort of control this game, and there's no way for you to decide exactly what's going to happen. Okay, so big lesson learned here in this specific trade. Hopefully you guys found some value into this. Should you have any questions or comments, please do let me know. Approach me on any of the social media that you find down below. And yeah, until the next one, thank you very much for watching.